Whether basic time value of money problems, stock valuation problems, or bond problems, we're always worried about value being a function of cash flows, opportunity, and time. Cash flows, opportunity, and time. COT, cash flows, opportunity, and time. So, in determining what the price of the stock should be, we start thinking about cash flows, opportunity, and time. So, let's document the rate of 12% as the cost of capital, also known as the opportunity cost of capital, or the O in the cash flows opportunity in time set. Then let's think about periods or time in our cash flows opportunity and time set. And we have right now, which I always put into column B, and then we have periods 1, 2, 3, and 4. So let's go ahead and look at time. Then we have cash flows. And if you think about the cash flows that you would get in, some of them would be what we call dividends. It suggests $1 in 1 year, and $2 in 2 years, $3 in 3 years, and then $5 in 4 years. So those would be the cash flows you could receive. Then you could also receive cash flows when you go to sell this stock at the end of the 4th year for $100. What that tells us then is that in any given period, we could total our cash flows so that in any given period, what you would get would be equal to those dividends plus your future price. So that in each year leading up, the cash flows then that you would get in total are the dividends until the end of that 4th year, at which point you would get both the dividends and the future price. So now why don't we go ahead and calculate the present value of those, where we will calculate present value for each period at a rate of 12%, which I'll fix by putting the dollar sign in front of the column B and the dollar sign in front of the row 10. This is for then the cash flows that would occur in period 0. Payment's a shortcut we don't often use. And so instead, I will skip over it by hitting double comma and then go to the total cash flows in as our future value. So that as I look at this stream of cash flows, what this suggests is if I was to get $1 in 1 year at a rate of 12%, I should be willing to pay up to 89 cents for it right now, thus the suggested negative. If I was to get $2 in 2 years at a rate of 12%, I would be willing to pay up to $1.59 for that right now. And etc. until in the last year, I would be willing to pay up to $66.73 for a $5 dividend and a $100 future price that would come at the end of the 4th year, assuming that what I could do instead would be to earn an interest rate of return on an alternative investment of 12%. Once I have those all calculated, I can calculate what we think of as being the intrinsic value, or in truth, it's just the total willingness that I have to buy all those cash flows. So this suggests I should be willing to pay up to $71.35 for this stream of cash flows, C, that comes at this opportunity, O, over this set of periods, time. Question B then says, if it sells for $69, what would you tell an investor? So if the market price was $69 and the intrinsic value means this is the max amount that we would be willing to pay, well, clearly, if the market is only asking $69 for something you think is worth 71.35 cents, then you would absolutely want to buy it. Buy it because you believe it's at a discount. The last question then says, what is the stock's current dividend yield? Dividend yield is a basic ratio analytic that says you take the next dividend. I like to indicate that as being dividend one, indicating the one that would come next or in this first period, and then divided by the price, which would be the price right now, suggesting that for every $1 you would spend right now, you would expect to receive this many pennies in interest rate return as a dividend. So in our case, if the next dividend is $1 and the market price is currently $69, that suggests a dividend yield of 1.45%.